It's Morgan Stanley's Urgent Warning. I'm your host, Steve Metre, and thanks for joining me today. In our headline story today, Morgan Stanley's analyst Michael Wilson, who was voted #1 by Institutional Investor last year, is warning investors that the worst is yet to come for stocks as we hit peak earnings season this week. But not all analysts agree. Others say it's inflation that's the biggest headwind for stocks. Who's right? Who's wrong? Let's go to Bloomberg, where we pick today's story up. Morgan Stanley says U.S. stocks aren't pricing weak data. Says the survey indicators point to earnings recession ahead, and that means stocks could go lower. The improving sentiment toward U.S. equities is at odds with a backdrop of weakening economic data and earnings, according to Morgan Stanley strategist Michael Wilson. And so here's the first test. So he's suggesting here that the economic data is going to get worse, and that's going to pull stocks down, even though many people are questioning what is driving stocks higher here. Let's put this to the test and see if we can find the answer. So here we have from this chart from the Fred database of the St. Louis Fed, the current new orders, a diffusion index for the Philly Fed. And what we love about this, it has a lot of history going back to the 1960s. And we know that new order demand is a big leading indicator for the economy. And overlaid on a year-over-year rate of change is the Wilshire 5000 or total U.S. stock market. Now, what we can see here, what we're looking for is, does the economic data lead the market, or is the market leading the data? And what we can see is the red line, and nearly every case leads the blue, even though it's a very noisy data series, leads it lower. We can see that going into recessions. We can see that going into the pandemic, and we can see that now. So the first question here is perhaps maybe it's not about the economic data. Maybe it's about the market and what it's doing and telling consumers about their confidence to spend. But let's dig a little bit deeper, because he mentions earnings here, but we don't have earnings data in the Fred database, but we do have corporate profits, which gives us a very close proxy to the same thing. So here you can see corporate profits after tax in blue, that's shown on a year-over-year rate of change, also against the total U.S. stock market or Wilshire 5000. And now the data here on corporate profits is only printed quarterly. So what we can expect and what we already know as we're heading into earnings season and what we've seen so far is that corporate profits are indeed going to come down. And we can note, though, and this is interesting, I want to come back to this a little bit later in the show, that you tend to see corporate profits bottom and then reverse direction kind of ahead of the market coming down, particularly in recession. So perhaps we need to find out what the real driver behind this is, because according to Morgan Stanley's models, well, it's going to get a whole lot worse. And here you can see our earnings model has been very accurate over time. This from Haver Analytics, FactSet, and of course, Morgan Stanley Research, saying that the Morgan Stanley Non-Purchasing Managers Index, their leading earnings indicator, has a one-year lead over the actual S&P 500 long-term earnings per share growth shown on a year-over-year rate of change. So the case that Michael Wilson is making here is that, look, earnings are going to come down, and that means stocks have to adjust for it. But do they? Or perhaps maybe stocks are already pricing this in. Let's keep going. One of the most vocal bears on the U.S. stocks warned on Monday that plunging forward-looking indicators will translate into an earnings recession and will end up hitting U.S. markets. Recent optimism around a less hawkish Federal Reserve, China reopening, and a weaker dollar, which we'll look at in a moment, is already priced into share prices, he wrote. Now, this is interesting because let's go back here. What is he says? An earnings recession. And indeed, this makes sense that we would experience that, particularly because earnings went so high due to all the fiscal stimulus, monetary stimulus, and then inflation. It was really a boom because we know that companies raised their prices and consumers could absorb them. Now we know that consumers don't have the same pricing power. So the logic of that we're going to have an earnings recession makes perfect sense. And again, I think there's a case the market already knows this. And let's talk about the dollar, because he mentions this, and the dollar is really interesting because we have the nominal broad U.S. dollar index in blue against the Wilshire 5000, again, the total U.S. stock market. And what do we know? That, even during recessions, as we head into recession here during the great financial crisis, the dollar weakened, and even though stocks were trending lower, they didn't completely break down until the dollar went shooting higher, telling us that financial conditions tighten. But here you can see other events where the market's starting to plateau out. The dollar weakens a little bit, giving it just a little bit of room to stay up. Here you can see the market coming down through 2016. The dollar drops, giving a little tailwind behind it. We can even see that here into 2021. The dollar comes down after the pandemic, and that is a big plus for stocks. So, you know, the question here is, why does that happen? It's simple, because as the dollar weakens, it alleviates the global dollar shortage, which is an important factor here. The other thing it does is it makes U.S. exports more competitive around the rest of the world, and that is good for U.S. stocks. Let's keep going. The question is, when will equity indices price the current weakness in the leading data and the eventual weakness in the hard data? According to Michael Wilson, who ranked in number one in last year's institutional investor survey. So when this guy talks, we should listen. He thinks it's this calendar quarter, and that's what his urgent warning is to investors, is because he thinks stocks are headed down over the next couple of months. And here you can see corporate profits after tax. Again, we said we're going to come back to this chart against the Wilshire 5000. Now, neither of them on a year-over-year rate of change, one in billions of dollars, the other just the index. And so what I want to point out is possible here that the market is already pricing in this earnings recession. It kind of knew it was going to happen. Stocks came down, but it's starting to show signs of a potential bottom here. And now the real question then becomes is, what would we need to see before the market really breaks down here? And perhaps that would be the 4-week moving average of initial claims, because you start to think about, you know, corporate profits and corporate earnings. Well, what can companies do to fix their margin? And that's what we're talking about is, hey, they really benefited from the pandemic and inflation. Prices are starting to come down. Consumers don't have as much money. How do you fix your profit margin? Well, simple. You put people on the unemployment line and you cut heads. And what are we seeing, particularly in the tech industry right now? Well, we're seeing just that. And what you can note here in this chart is you see as corporate profits come down during the great financial crisis, unemployment heads higher as a 4-week moving average and initial claims goes up. And look what lo and behold happens during the middle of the recession is corporate profits after tax head higher. So really the issue that we perhaps are looking at is not these forward-looking economic indicators of the hard data that Michael Wilson is suggesting, but maybe we should be looking at the one data series that matters, and that's the labor market. Earnings are also a concern for JP Morgan Chase strategists, who notes that the environment will be particularly challenging this year with corporate pricing power starting to reverse. Just here we just talked about it, as margins are near record high in the US and Europe. So we already know that margins need to come down a little bit. That market, I believe, is pricing that in already. But as she said, hey, this is an issue, but what is solved very easily by is cutting the head count. You know, and so what you start to see is analysts are saying, look, earnings matters, profits matters, fundamentals matter, all these things matter, but there's one thing that we can't shake away from is the market looks like it's pushing to go higher, because this is the one thing I think a lot of investors really don't understand is that following 2008, following the great financial crisis, the market changed because more and more companies got burned by missing that big downturn, and so they started switching to trend following models. And that's why I created CTA-Timer Pro. I forgot to raise the price. I need to get to that very soon. But here you can see, just looking at how the machines are positioned, you can see in the very fast model, where there's not as much money invested in this from these major investment banks, it's sitting at 100% long positions. But look at the slower models here. This is where we see a large portion of companies allocate to slower moving models, and the models are still long. And that's why you're starting to see this thing not really sell off here, because if you see momentum of the market build, what's going to happen with these trend following machines? They're going to go and buy more stocks. And that's the advantage of CTA-Timer Pro. Link in the description, still $20 a month. Get it before I raise it to 30. And now let's talk about what's going on in the inflation side of the story, because a lot of people actually believe now that inflation is really the key here for equities. And really, that's why I wanted to point out it's all about the machine positioning. That's why that report is so helpful. Wall Street Journal headlines: market recovery hinges on quick inflation drop. or does it? Is inflation the story here? Avoiding a serious downturn while inflation falls quickly would be a Goldilocks scenario, according to Liz Ann Saunders, the chief investment strategist at Charles Schwab, per which everything would have to go right. So here again, she's suggesting that it's not about earnings or profits, it's about inflation. And maybe there's something to that story, so let's take a look. And what she kind of, I think, is pointing out in her statement is that when you see inflation come down, usually that is a red flag for stocks. You can see going into recessions, inflation comes crashing down, stocks go down. But there is points, there are times where here you can see between, say, roughly late 2011 and into 2015, 2016, you see inflation in blue went down and yet the stock market went up. So this really is almost a conundrum, a question of, if inflation is coming down, is it the rate of inflation coming down, or is there, again, another catalyst here? Well, if you might have already figured out, there's another catalyst. And here we can see if we now take the consumer price index, overlay the 4-week moving average of initial claims, and here you can see inflation coming down into the 1990s as unemployment claims rise. You see it again in the dot-com bubble. If claims are going higher, inflation is coming down. And you start to get to the picture here that when people lose their jobs, and yes, they do have the support of the unemployment network across the country, their wages go down. And when their wages, effectively because they go from earning money out of job to the unemployment market, well, what happens to their spending? It declines and inflation comes down. So now the question is, what really happened during that 2012 to 2016 period? Well, that means claims continue to fall, and that's key. Inflation came down as fewer people were filing for unemployment claims. So what this tells us right now is what is critical, what we should be watching over the next couple of months is, do unemployment claims start to rise or not? That is the key point. If they remain low, if employers tend to hold on to employees and the market stabilizes here and the economy stabilizes, well, it doesn't mean stocks have to go down. It actually suggests we can have an earnings recession and get through it. Bob Michel, the Chief Investment Officer for JP Morgan Asset Management, cautioned that it is premature to assume that inflation will continue an orderly drop through the rest of the year. He says if it flares up again, the Fed could resume raising rates, he believes. There's a lot of reasons for the Fed to pause and see what happens, but there's also a lot of reasons they may have to go and keep hiking. Monica Defend, the head asset manager of Amundi's Research Institute, is also concerned the inflation consensus is too optimistic. She projects the annual rate will fall no lower than 4% in the next 12 months and advising a cautious approach to equities. We don't believe the 2% is a feasible target right now, but actually it is. And here you can see in this chart the consumer price index for all urban consumers, the CPI, against U.S. regular all formations gas prices, both shown on a year-over-year rate of change. And what we can note is that gas prices are a leading indicator for inflation. When they get down to this magic zero number where it's sitting now, well, that translates to about 2.5% year-over-year rate of change on headline inflation. If for any reason gas prices should go lower here, well, that means inflation is likely to get to the Fed's 2% target. And of course, we know the CPI is a highly lagging indicator. So what we're seeing here is potentially, Michael Wilson, I think the market may be pricing in the earnings recession. And if that's the case, we're already seeing inflation come down, which the market is already pricing in because, well, the bond market knows that. So it's possible we're just in the eye of the storm here. The economy may actually plateau out. And we'll see over the next couple of months. If employers hang on to workers, well, that's a good sign. If they don't, well, watch out below. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.